welcome to the closing beat, everybody. Happy Friday. How you doing out there? You're joining us from the Speakeasy here tonight, today. Actually, remember, we said we would record Friday's video for you just to get everybody out of here earlier, but Monday through Thursday definitely be live. And then if like Fridays are wild or something crazy happens, of course, we'll cover it there. But yeah, this is the Speakeasy. Here's where we hang out on Thursdays for our customers. We're financial advisors with Jazz Wealth. And hope you'll come check us out. But in the meantime, I'll do something for you, teach you a little bit of something, hopefully, and give you an update of the markets. And I've got some cool things to share. We're going to talk about one last little fun Friday geeky study for you here in just a little bit. But let's start with the markets. You see on the screen there, you've basically got the stock market down 2% across the board, 2.5% depending on where you're looking there. Dow was one of the bigger losers here today, at least in terms of the three major averages there. Let's take a look. Let's just go do this, man. It's Friday. Let's have a good time here. You've got the S&P on your screen. I'm going to go over here to the Dow, rejected by the 200-day moving average quite a few times there. So from a technical perspective, that's not good. You don't like to see that sort of thing. But you've got a nice little pullback. A lot of people have been waiting for pullbacks here. You've now seen that pullback, or at least the start of it. You've got the NASDAQ here now 4% off of its highs, I do believe. I took a look at this yesterday. Yeah, now just over 4% off of its highs there. Those of you that have wanted tech to pull back, you got your wish. I'm going to go through some of that there. 2% pullbacks off of highs are rather rare, but they're also bullish, by the way. So maybe we'll cover that on Monday for you. But NASDAQ pulling back, so that's a good sign. S&P 500, there you go. Down about 2.5% on the week so far. 3,000, your magic number. The 3,000 support area, a whole number, psychological number people look at. Also, the 200-day moving average, basically that's where you're hovering, right around 3,000 today, as you can see. So that's what you have on the S&P. And by the way, 95% of the S&P now has a higher yield than buying a 10-year bond, right? The 10-year is now yielding so little that 95% of the S&P is yielding more than that. Like we've said in the past, the Fed's just essentially forcing you to invest in the stock market there. And then also, you had Morgan Stanley come out today and said, not only are we having a second wave of the coronavirus, but we're going to have a second round of shutdowns. That was their belief. That's what they're showing their customers. And so a rough way to finish out the week, but a good news for those of you that have been waiting for a pullback. Some economic news I thought I'd cover real quick. I'm going to pop over here. Here is the, these are the virus counts per day. It's a little bit off your screen. So what can I do? I'll go like this and try to help you out with this because I want to make sure this gets in there. That's too big. These are virus counts per day here in the States. We talked about this on Wednesday. They didn't need much to hit a new high, and we did the very next day. Well, today we've now hit this sort of new record here for virus. The virus, it's just nasty, man. Look at that number of cases per day sticking out to you. Just crazy. If I take a second here and just go Florida cases per day. Here you go. We're not helping the case down here in Florida. Take out the U.S. Here's Florida, 5,000 cases a day. Everybody put your mask on because it's nasty down here in terms of that. You now have 9 states with positive test rates over 10% in terms of the virus there. So, right? Not looking too good there. We'll cut back over here to some economic news real quick. Just thought this was interesting. Import-export numbers came out from the census there. They were terrible. Not only were they the worst month-over-month change ever, but the number of imports and the number of exports have declined to a 10-year low. This was truly a terrible, terrible economic number if you happen to be paying attention or care about that sort of thing. This wasn't just bad, and I get it, oil prices, there was an issue there, maybe some of that weighed into this, but even if you add that back in, this was still one of the more terrible, if not the most terrible economic data point we've seen so far this year. We'll point that out. Not the greatest, not one you wanted to see there. Hey, FinTips videos this week. We did a lot of interesting things. ETFs, how to pick them based on volatility, not just picking the one that has the highest yield. We did how to sell a stock, pick a stock, how to manage a stock. We did all kinds of good stuff with stats on our FinTips video from Wednesday, and today, of course, was part 2. Hope you'll check that out. Wine and Wealth last night, we talked about taxes. We talked about a study. We talked about the tax extension, tax deadline extension there. Kind of interesting. And next week, we're going to do something interesting. Monday's video will be on, is it better to buy a house at a lower interest rate, higher price, or higher interest rate, lower price? So we're going to analyze that a little bit, and I'll try not to go too crazy. And we might also focus on the Robinhood traders. We've got all the data from there, so maybe we'll put together a couple things about what you guys are trading over there at Robinhood. Moving on, let's go to our sector breakdown here and take a look at what's happening in the overall sectors, at least for today. I'll pop this guy up and we'll come back to that in a second. Financials, that's going to be your weak spot today, reversing everything that it gave you yesterday. 4% lower on the day. Second worst on the week, down 5.5%. It was the weakest here today. That's a tough one there. Fed stress test by now, you know, they've told the banks you can't raise your dividends. You can leave them the same provided that your income justifies it based on a formula that the Fed has determined. They have essentially nationalized the banks, by the way, if you care about that sort of thing. Issues here. Banks will make the determination, or the Fed will make the determination on the bank's dividends that they pay out based on their income, and it's going to be based on, well, delinquencies are going to play a big role in this. I mean, they're just going to play a huge role in this because you got more delinquencies out there. I've told you we're going to expand on that and some of the data there, but that's likely going to hurt them. You've got Capital One, which expects $7 billion in losses from the people just being delinquent and eventually not paying their bills and having to charge them off. That's crazy. That's going to hurt their dividend overall. So that was the big one there. Wells Fargo seen as the one that's going to be hurt the worst out of this, down 7% on the day. Well, just for today, down 7%. Goldman Sachs seen as one that's going to be hurt by this as well. JP Morgan is so far seen today as one that's going to weather this storm just a little bit out of all of them. So we're trying to pay attention. That doesn't mean it's the best performer. You could just kind of see today that people are kind of making that bet. Let's move on. You got communication services. Wow, 4.4% drop. Didn't mean to sound like a guy riding a roller coaster, but you know why this is? This is, it's going to be Facebook, right? The biggest contributor to the downside today, it was Facebook. It's the second weakest today, mostly due to Facebook. Let's take a look. You got Facebook with a pretty nasty day. It hasn't seen one of these in a while, down 8% all the way back to the 50-day moving average. Verizon, Unilever, Lending Club, and others are now pulling their advertisements, or I should say they're pausing their advertisements from Facebook due to some of the, well, obviously you know what's going on, but due to, I think, Facebook's response to what they said. They said, we don't make changes based on revenue pressures. So they sort of fought back there. They put out some good things there that they were going to try to do, but those companies also pausing their advertising on Twitter as well, which put those shares down about 7% on the day. It's now 20% lower from the recent highs here. So if you like the idea of a Twitter at a 20% discount, there you go. Energy sector there, about 3.4% lower on the day. Wraps up a really tough week. Lost about 8% on the week. That's the worst for every sector out there. Every stock in the XLE today was down. There were none that were positive. ExxonMobil down 3%. That was one of the bigger contributors. Chevron down 3%, also one of the bigger contributors. We look at tech. That continues to pull back there. It's basically flat on the week, but it gave back all of its gains from earlier in the week. That topping tail continues to hold true for tech there in terms of being a warning sign. We used to joke around, we call it a middle finger. So if you look at it, it looks like a hand, right? So you're moving up here, the stock market or the sector gives you the middle finger and starts to pull back. These are your knuckles. You get what I'm saying? For the kids out there that want to get a little laugh out of that. Consumer staples, there you go, was basically holding in really in line with the market. Got a little weaker at the end of the day and did close right smack on the lows. Have a feeling if the markets wouldn't have closed, this one would have sold off to outperform to the downside. It just had that pressure going for it. And so consumer staples, you have to say, basically holding in line today. Lower volatility, tighter range, not as scary. People looking back at some of these names, Clorox in the mix today was actually positive on the day, and Kroger held its own, which it has been holding its own. But with the whole virus concerns and everything, people moving back to ideas of looking in that sector. Gold, kicking butt over here. We talked about this earlier in the week, gold and the assets under management for the price of the, or for GLD and what's been going on there, along with the technical analysis of that. And that is continuing today, up $9, 17.80 an ounce is where that one is going to wrap up there. Down 26 cents today, 38.49 for the price of oil, if you're paying attention, just a small down move there. And that is basically it for the sector breakdown. Let's go over to some of the technical stuff going on in the news here, see what I can help you with. You got 5 new highs today. They all finished in the red. So they all went up there and then kind of faded away. I don't know if it matters to you. That doesn't belong there. ResMed, new 52-week highs extended. It's okay that it's pulling back here. Not a big deal. A lot of things are okay that it's pulling back. Tractor Supply, great run there. Okay that it's taking a break. It makes these things attractive for people to come back. West Pharmaceutical, same thing. 52-week highs pulled back a little bit. No 52-week lows. We will now be going on 7 weeks with no 52-week lows. That could be changing soon, but we'll see. ConAgra, this is a watch list one we've been talking about as a potential breakout. It's going to be a while, so you put it towards the bottom of your list. Just check on it every couple days or so. CHRW holding its own. Not bad today. It outperformed it, not only its industry, but it outperformed the markets today by only losing 0.85%. It's not great. You like to see it get up and going there from what we've been discussing, but it's okay. I thought Ameriprise did okay today considering how much it could have given back. Down only 3% on the day, sitting around the 200-day moving average. 1 or 2 good days in the financials, I think, wakes this one up. And we talked about Ross Stores maybe being extended in the short term on the downside here. However, this one being the most challenging because most of their stores are based, 68% of their stores based down here in the South. And we're unfortunately all carrying the virus, apparently. So that's a tough one there. And that's where I'll wrap that one up. Let's do stocks in the news, and then I'll share a quick study with you and get out of your way. Stocks in the news here today. You're going to want to pay attention to if you have Office Depot. Office Depot is doing a 1-for-10 reverse split. This will take place on the 30th. It'll be June 30th when that takes place. Just to keep them relevant. So there you go. Slack. If you work for Slack, you're working from home forever. They said today that all their employees will work from home indefinitely. I get it. I mean, why do they need to be there? I mean, it's a powerful lesson some of these companies are learning. Albertsons didn't do as well as I think people probably hoped, especially the company here. This is pulling the wrong logo. This is the old symbol. It's actually Albertsons now. Opened up at $16 today. They priced at 18 to 20, so a little bit less than they were hoping for, but still not a horrible showing. And just bad timing really for them. So I wouldn't assume that there's anything wrong there. All right, dividends you got coming out from Medfast. I think it was $1.13. Illinois Toolworks paying out $1.07. Yeah, holding its own too, by the way, from a chart perspective there. Camden, this is a REIT. They're paying out 83 cents. You got Humana paying out 63 cents. And John Deere, 76 cents for you dividend players out there. And let me help you out with a quick lesson, if you'll allow me to. We talked about that. That there is scary. I don't like that one. Here's the question that I want to ask before we get into this one. All right, think about this. We had a bear market. First quarter of the stock market, horrible. Second quarter, which ends next week, really good, right? What we're looking at here is we're saying, okay, we came out of a bear market and we've bounced to some degree. In the early stages of bouncing or recovering from a bear market, what percentage of time do we spend pulling back versus going higher? Because it's very easy to say the markets have done nothing but go up. If I were to ask you, since we hit the virus low to today or yesterday, would you say that the stock market has spent more time going up or going down? And visually, I can totally understand where you would go with this. The correct answer, although it will be proven wrong shortly, would be to say going up, Dustin. I think the markets have spent more time going up. That would be the obvious one. Look, it's going straight up. But the stock market has actually spent more time pulling back than going up, although it doesn't look like that. So let's break it down here. And then from that, what we want to do is say, is what's happening now odd versus what's happened in the past, okay? So here we go. Let's go over to it. This is a percentage of time that we've spent pulling back relative to the other data points, but focus over here for a second on the blue. We have spent 70% of the time now, as of today actually, 70% of the time pulling back versus going up, but yet we have this monster rally. So isn't that interesting? I mean, now when you analyze every single day in the stock market, well, more times than not, we've been in a pullback versus trending higher, although the overall trend is higher. All right, but what we want to do is compare it to every other time with the same time frame, and we want to look and see if this is abnormal. In other words, is this market pulling back 70% of the time something to be worried about, or is it normal? And very quickly, you can actually look across the screen here and see that in the first 3 months following a bear market, which is where we're at the moment, it's actually very normal for the stock market to spend more time pulling back than going higher, yet still achieving positive returns. What? How cool is that, huh? So just one of those, we just trying to think of something weird. Like what do we share that's just unique that you wouldn't have seen? Because our research site should be up Monday, Tuesday-ish. Got to get the last little pieces there, but it's about ready. If you want to check it out, jazzwealth.com/research. If you're not one of our customers, you can join there. But this is the kind of interesting things that I want to expand on to get you thinking about the market in different ways, because if I can get you to think about it in different ways, it will lead you to new ideas, new strategies, new picks, new stocks, new investment options, things like that. Well, anyways, that's pretty much all I have for you. I hope that was helpful and you learned a little something today, and we'll get out of your way, get this thing off to you, and I'll wish you a great rest of your weekend, and see you next week. Adios.
Why should you choose Jazz Wealth as your retirement or long-term investing service? Our portfolios are managed by us, not some faceless mutual fund manager. Our private classes will teach you everything about investing and getting your dough straight. Best of all, our fiduciary standard means your best interest comes before ours.